If you have over $200,000 sitting stagnant in your bank, retirement account, or home equity, then you're literally losing money. On this show, you learn how to get that money working for you consistently and conservatively. Learn to grow your nest egg with your host, Shawn Winslow. Let's dive in.
Welcome back to another Multifamily Monday episode. I'm your host, Shawn Winslow, and this is the Multifamily Money Podcast. What is going on, everybody? You know the drill. Every Monday we come at you with all things multifamily real estate investing. And today's another solo show. It's a topic that you've heard me talk about before. I just want to get right into it. How are deals getting done right now? You know, obviously rates have gone through the roof. It's the highest we've seen the Fed raise rates, it's the fastest we've ever seen the Fed raise rates. You know, we're seeing loans that are at 60%, 50% LTV, which then obviously requires you to raise more capital, right? So how are deals getting done right now? And we're still seeing like 15, 16% IRR, sometimes even more, you know, like 20% average annual returns, 2x equity multiples. Like, how is this still a thing? Because we all know one of the powers of real estate is leverage. And that's how you're able to get some of these solid returns. So how are they still doing it when leverage is 50 to 60% LTV? Like, how doesn't that just seem risky, or are we really seeing the whole picture here? And no, it's something I've talked about in the past, and I've talked about how there's multiple ways to structure your what is known as a capital stack. So capital stack is, you know, your debt, your equity, essentially the pieces to put the puzzle together, right? Your capital stack. And you've heard me talk about this before. Where recently, probably in the last month or two, I've talked about this, where people are bringing in something called pref equity, some even mezzanine debt. And that's where you'll get your traditional loan, whether that be agency or bank. You'll get 50 to 60, maybe 65% LTV. And then that remaining, you know, 20 to 15% to get you to that, you know, either 75 or 80% LTV will be something called preferred equity or pref equity for short. And these are these big equity allocators. So these big pref equity players that have to allocate money, right? And so they allocate it to deals, and they'll give you, you know, maybe that 10 to 15% of your raise. And they get a preferred return, and they're the first to get paid. And I would really this is just a over level or kind of high level of what I'm about to get into. And the reason why I'm talking about this is because I was perusing the Twitterverse, right? And I came across this guy who it was a suggested tweet by Cole Konevsky. I want to give this guy credit because he eloquently puts this out there. He eloquently writes, puts in words better than I think I can, how people are structuring deals and how they're still looking really juicy. So I'm just going to go through what he tweeted. And I just wanted to give him credit, Cole Konevsky, give him a follow up here on Twitter. He has some great stuff out there. And this is exactly what I've been talking about. And he just lays it out perfectly. So I just want to go over this. It's a thread of tweets. So bear with me one moment. It's going to be a combination of me reading this to you and kind of putting my spin and my points on it. So he starts off saying syndicators are in a tough position. They have two options right now, refi or sell. And these are syndicators that he's talking about that currently hold positions, hold real estate. He says for most syndicated deals are structured with a waterfall based on IRR, internal rate of return, thresholds. I've talked about this before, how you have your waterfall. So, you know, you meet certain IRR thresholds. So once you get to maybe 10%, then there's a different split, 12%, different split, 15%, different split, so on and so forth. And so then a refi, if you're to do this, it extends the time frame, and you got to think time value of money, you know, present value versus future value. You know, can you do more with the money now? If you took it now, then you took it later, right? So when you extend the time frame, it generally diminishes the IRR and therefore your promote, so which is known as GP profit. So that's why you see some of these massive IRRs over the last few years, because, you know, they're flipping the property in 12 to 18 months. And it juices the IRR. Another reason why I think, you know, IRR can be a little overrated. Then he goes on, there's a large amount of debt coming due in 2023 and 24. Of this debt, there's a large portion that is high leverage. Think back for the last few years, it's been a lot of bridge loan, with 70+% LTV, 75, 90% LTC, which is even more, right? And LTV, because loan to cost includes your CapEx, and low rate, 3.5%. Although rents have moved, many loans will either pencil to sub 65% LTV and or cash in loan at a higher rate of 5 to 7%. Many of these owners bought high and have little reserves budgeted for rate risk, which is very true. Even more will have to make a capital call if it's cash in refi. Very true. So you refi and you have to actually bring cash in, because how high rates have moved and how low the LTV is, you actually haven't created enough value to refi without bringing more capital in to satisfy the lender. So your 25,000, 100,000 investor is not stroking a check with the stock market down and macro economy outlook. So what happens? They sell. Fortunately, a ton of deals should still be worth more than purchased in 19, 20, 21 from rent increases, which is true. We've seen unprecedented increases in rent. They are now base hits and time is of the essence. The hard part is who buys the next deals. This is very true. Who's going to buy them? We've already seen institutional players take, foot off the gas. Definitely syndicators have too. I'm not seeing as much competition. The brokers I'm talking to are not seeing as much competition. So who's going to buy these next deals? Syndicated multifamily deal is generally 5 to 40 million. Let's start with the simple capital stack. So 12 months ago, you would see probably 35 million debt on a $40 million deal, and then you leaving a $5 million equity check. Yeah, very common over the last couple of years. Today, the deal might be worth 50 million and qualify for 25 million in debt. So 50% LTV, leaving 25 million of equity. One, it's a lot harder to raise 25 million and 5 million. And two, that's obviously going to dilute your returns, right? Because as we know, leverage is one of the powerful factors of real estate and allows you to provide some very solid returns. So now think of the deal profile. Syndicators generally focus on assets with value add, what we do. 80s vintage with old interiors, yep, what we do. Renovating 25% of units, prove out the business plan, then sell the dream. That's what a lot of them do, for sure. Because, they could do 50, 75, 80, 100% of the units and increase the value even more. But then it's that last point. You got to sell the dream, right? So you leave some meat on the bone. So when rents were going crazy, that was an easy dream to sell, right? The proven track, rents are still increasing. Now we have a level of uncertainty. It is not prudent to assume huge renovation premiums or continued 15% lease tradeouts. Sometimes you even see 20+% lease tradeouts, which is crazy. So the next buyer's business plan, in theory, should look much more conservative. And that's what I've been telling you all. This is much more conservative, even though you still might, for this month, maybe next, get some crazy lease tradeouts, some crazy rent growth. You cannot bank on that for the duration of that holding, of how long you're going to hold that asset. You have to be conservative. I've been harping on this, and I'm glad he brought that up. And then he goes, there's more. We've established that this is likely a 30 to 50-year-old property that has been owned from the past few years by a group that is likely less than experienced. True. We've seen a lot of people enter the market over the last couple of years that are new. There's nothing wrong with that. But you just got to realize that there's probably going to be a lot of deferred maintenance across. He goes on to say, not too crazy to think $2 million worth. Yeah, it's not crazy at all, especially on a property, $50 million property. And so where does that $2 million come from? A couple of years ago, you would have gotten a bridge loan and they would have, 75 to 100% LTC. So they would have lended on, 75 to 100% of that $2 million. And it would have been at a low rate. So it would have been a no-brainer. So now a buyer either is going agency or a bank loan, which most bank loans have recourse. And no one's going to sign recourse on a $50 million deal. At least no one that I know. Agency is not going to, they don't lend on CapEx traditionally, not at all. So it's going to be, LTV, not LTC. So it's going to be that 50 to 65% of purchase price. So of that 50 million. So that means the 2 million you will have to raise. So instead of being 25 million, now it's 27 million. And that's going to obviously make the raise harder, which is actually $2 million. And it's also going to dilute your returns. So again, that $25,000, $100,000 check writer has been making 2X's every 18 months, the past few turns. So if they aren't informed, they don't want to see 12%. If they don't really know what's going on in the market, they're not going to want to see a 12% return because that's not what they've been getting. And he goes on to say, notice they probably aren't dialed in, which is true. And that could be a factor of just not really understanding where the market's going, and they're still seeing some juiced returns. So they think it should still be that way. And also just from a psychological standpoint of, they've just been accustomed to seeing that number, and they don't want to admit that that's not the type of return they're going to get anymore. So that makes syndicators have to get creative. You either don't buy or you get creative, right? And so the answer to that is, which I've been talking about for the last few months, is pref equity. And these funds are raised and need a home, or it's sent back. And obviously these huge cap allocators, they can't send back money. That's unforgivable. That if they do that, they're probably not going to get allocated in the future, right? Like they're giving the money to allocate it because they need a return. They need to find a home for it. So they have to put the money out, and syndicators need the money to keep everything going forward and moving, right? So a lot of pref equity buyers are catering their funds in a unique way across the capital stack. So they will sponsor. They will have the sponsor take a 50 to 60% agency loan, write a 20% pref check. So that gets them to, 70 to 80% LTV, and participate in the GP LP split up to 90 to 95% of the deal. This, obviously, they do this because it protects them, right? If the deal goes south, the pref provider will take over the low leverage loan, and all profits will make the pref piece whole as they are first equity position. Then the LPs, after which the GPs get the remainder. And he goes on to say the irony is pref inflates LP returns in your model, which is so true. And I've been trying to hit on this. You'll still see people with like 18% IRR. It's like, what? Like, there's no loan assumption here. There's no, they're getting a high rate debt. It's a huge raise, and their LTV is definitely lower. How are they doing this? And this is how they're doing it because, that LP sleeve is small, and it's getting juiced by the pref equity. And so he goes on to say, therefore, groups are taking down deals with huge pref pieces and are able to show 15% plus LP IRRs. And that's how they're doing it. And then you pair this with thin operations, tight exit caps, and little reserves, which I see underwriting, and there's definitely little reserves. It's crazy. And you create big paper returns. So this is who's winning deals and raising capital. That's how they're doing it right now. And he goes on to say, as an unsophisticated investor, you think, wow, the party is still happening. Yeah, a lot of people think that. So you continue to pour money into those deals. Meanwhile, to shore up any shortcomings in cash flow, your sponsor raises a few mil over required raise to pay you out on your own money, which is so crazy to me that people do this. I'm not going to go any further, but you can probably think what I'm thinking. What does that feel like, right? It's crazy. At the same time, a $20 million pref piece is collecting 7% current payments month to month and accruing another 6% from the actual cash flow shortcoming. A large portion of returns are then left to exit. Yep. Investors won't really know there is a problem until there's a problem. So true. This is happening at scale right now, at least sub-institutionally. For the most part, I think institutions are protected with durable assets and longer-term, lower leverage debt. On smaller deals, this makes me think the opportunity is coming as distress builds. I don't think there's necessarily going to be fire sales and rock bottom prices, but in cash flows are starting to control trades again. Patience will start to pay soon. And I couldn't agree with him more. I think that was very eloquently put. And that's essentially what we're seeing right now. People are, syndicators are still trying to get deals done. And I don't blame them. I'm trying to do deals. But you just you can't act on emotion. You got to be conservative. You got to think what's best for your investors. And, I'm not saying prep equity is bad. No, I'll probably use prep equity in the future, but in the right market environment for the right reason, not just to juice LP returns and, to force a deal to get done. And I'm not saying that a deal can't be done now with prep equity that makes sense. There's definitely deals out there that does make sense, but you just have to be careful. And if you're an LP listening to this and you're looking at deals, I would, dig into it, see what their capital stack is, ask the operator, the sponsor, questions about the capital stack. Where are they funding this? And if they are using pref equity, what does that look like for you? What are your reassurances? Because you're obviously going to fall behind them in the capital stack. So the pref equity is going to get paid first. So I just wanted to bring this to light. This is something you've heard me talk about, and I saw this tweet and he just eloquently put it. So again, I want to give him credit. Cole Konevsky. So check him out on Twitter if you're on Twitter. Great follow. So as always, thanks for tuning in. And as always, if you did find value from this, one, give Cole a follow for sure. But also, please share this podcast with others who could get value from this. And if you haven't, please leave a rating review on Apple Podcasts. It's another way we get in front of more ears out there. So yeah, as always, thanks for tuning in. And remember, easy doesn't pay well, and instant gratification is self-destructive. So get out there and not only work hard for your money, but have your money work hard for you, so we can all create the lives of our dreams and make this world a better place. All right, everybody. I'll catch you on the next one.
Hey, this is Shawn Winslow. After being in the financial service industry for years and having candid conversations with good people just like you, I realized that so many of us are wanting an investment strategy that provides solid returns and consistent income without the bumps in the road. There's little known secret that your financial advisor doesn't want you to know. There is an investment out there that is less volatile and the returns are stronger. Get more details by going to greenbriercg.com and clicking on the free e-report. And by the way, if this show has provided you any value, then feel free to leave an honest written review and of course share it with a friend who needs it. See you next week for another great show.